moving from your regular income into retirement income can be a little bit confusing, especially at first. And it's definitely easy to overcomplicate it, but you don't have to. And in fact, as long as you know a few key things, you can really keep it simple while saving yourself a boatload of tax and grief. My name is Reese. I'm a chartered investment manager, a fellow of the Canadian Securities Institute, a financial planner, and the founder of Well Built Wealth. And building withdrawal or decumulation strategies is something we do pretty much every single day. And that's because it's crazy important. The impacts of doing it properly are massive. Or maybe I should say it like this: the impacts of doing it poorly are massive. But either way, there's so much to a topic like this that it's very easy to get into the weeds, but we're not going to do that today. We're going to focus on three heavy hitters, three must-knows that have outsized impact. Let's dive in. The first absolute must-know is how tax rates work in Canada. Now, I understand that this topic is about as exciting as being kicked in the face by a horse, but if you give me a couple of minutes, I will show you that it's actually really super simple and not at all scary. Well, the amount we get taxed is scary, but how it all works, that's pretty easy peasy. In Canada, we have what is called a progressive tax system, and it's called that because we are taxed progressively, more aggressively, the more we make by both our provincial and the federal government. It's a tag team effort. Let me show you how it works using Ontario's 2024 combined provincial and federal tax rates as an example. And I'm using charts from EY because they're really straightforward and easy to read. And I'll post a link below so that you can check out the combined rates for your province. Anyway, don't get too fussed about how busy this chart is. I'll show you exactly what you're looking at here and what you need to pay attention to. The first row is simply showing how much you are taxed on the first $15,705 of income. As you can see, it's 0%. After the applicable tax credits, which we're not going to get into today, you pay zero tax on the first $15,705 you make. And this goes for any income you make: dividends, interest, capital gains, RSPs, and RIF withdrawals, etc., etc. Many people have no idea that this is the case. They assume that they have to pay tax on all of the income that they make, but this isn't so. We have levels, and each level is taxed at its own rate. And you can see this by looking at the next row. Any income that you make between $15,706 and $18,062 is taxed at 15%. Now, of course, as is noted in the footnotes and on the next page of this document, there are tax credits that can further lower the amount of tax owing, but let's not get into the weeds. The key point is that this level of income is taxed at a different rate than the previous level. An extremely common misconception is that once you move up into a higher tax bracket, all of your income is now taxed at that higher rate. But again, this is not so. Each level is taxed at its own rate. So if you made $17,000 of income, the first $15,705 would be taxed at 0%, so no tax. And only the amount between $15,706 and $17,000 would be taxed at 15%. If you made $80,000, now you'd be into the 29.65% tax bracket. But again, not all of your income would be taxed at that rate. Only the amount between $55,868 and $80,000 would be taxed at 29.65%. The amount between $51,447 and $55,867 would be taxed at 24.15%. The amount between $23,727 and $51,446 would be taxed at 20.05%, and so on. And yes, that first $15,705 would still be taxed at 0%. This is so important to understand. And like I said before, it's really easy to understand. And if you really get it, it can help shape your decisions and save you a ton of money in tax. For instance, maybe you have a solid amount of money saved up in your RRSP/RIF account. and you know you need $45,000 a year in retirement income. Well, if we look at the tax rate chart, we can see that at $45,000 of taxable income, your top tax rate will be sitting at 20.05%, which isn't fun, but it's a whole lot friendlier than the next rate of 24.15%. So depending on your situation, you may want to consider drawing a bit more out of your RIF account just to get you up to that next tax bracket without crossing over into it. Basically, rather than setting up your income at $45,000, you could consider beefing it up to $51,000 and change so that you can pull out a little extra from your RIF account at that relatively low tax rate of 20.05%. Now, this isn't always a good idea. If you have fairly limited resources, it may be wise to just pull out only what you need when you need it. But if you have decent-sized accounts, this can be a really intelligent way to get more money out at lower tax rates. And remember, just because you pulled it out doesn't mean that you have to spend it. You can still save it in your cash reserves or your TFSA or whatever. You have options. The key is you need to know where you sit tax rate-wise so that you can figure out what makes sense for you. And again, the larger your accounts are, the more it makes sense to plan this out in advance, because down the road, you could find yourself in a situation where you're forced to pull large chunks out of your accounts each year, forcing you into higher and higher and more grotesque tax rates. And this can happen for a variety of reasons, such as the minimum withdrawal requirements that most registered accounts have, the need for a large purchase like a vehicle in a given year, or even because of death. So yeah, depending on your situation, you could save a hardcore amount of tax by pulling out a little extra each year while you're at those lower tax rates, rather than waiting till later and getting hit by larger tax rates. But the flip side is true as well. Let me explain. Maybe you were planning on having a retirement income of $60,000 a year. Well, if you look here, you can see that anything above $55,868 is taxed at 29.65%. versus the next lower tax bracket of 24.15%. So that top chunk of income you are wanting between $55,868 and $60,000 has an extra 5.5% of tax on it. Now that only works out to $227.26 of extra tax, so it's not the end of the world. But year after year, it adds up. So if you can avoid it, you should. If you can manipulate where your income is coming from and include some no or lower tax sources of income to bring your taxable income below that $55,868 line, then you may want to consider that, especially if the numbers you're dealing with are bigger than what they are in this example. And in much of the planning work that we do for clients, they are bigger, much bigger. And so the tax savings can be bigger, much bigger. Now, I will say there may be additional tax credits that can bring you down into a lower tax bracket as well. So don't get too hung up on the exact numbers. It's the basics of how this works that really matters. Now, you might be thinking, that's all well and good, and very, very cute even. But what are these lower or no tax sources of income that you're talking about? Well, I am tickled pink that you asked, because that leads us directly into must-know number 2. How stuff is taxed. Yes, most sources of income are fully taxable, regardless of whether you're retired or not. But not all of them are. Some are not at all taxable, and some are just taxed less. And knowing which is which will enable you to figure out the smartest way to build your retirement income so that you don't end up unnecessarily in higher tax brackets like the last example that I was talking about. So let's get to it. Let's break down which is which. And we're going to start with the fully taxable sources of income. Now, of course, this list is not exhaustive, but it definitely hits the most common sources in retirement. Canada Pension Plan and Old Age Security. Now, I know that's really annoying, but it's true. Both of them are fully taxable. All withdrawals from RRSPs, RIFs, and LIFs. And there are definitely more registered plan acronyms than this, but these are the main ones. Rental income. Yep, fully taxable, minus expenses, if you're doing it by the book. Defined benefit pension income. Income from a job. Now this one is pretty obvious, but it is worth noting in case you want to add some employment income into your retirement sources of income. Any new income that you add in is absolutely going to affect your top tax rates. And so at minimum, this should cause you to do a serious review of where things are at so that you don't have all these things running on autopilot and forcing you, again, unnecessarily into higher tax brackets. So you just want to keep an eye on that. And the last one I'm going to mention here is interest income in non-registered accounts. Now, don't get spooked out about the word non-registered. It's simply a regular account. Any account that is not an RRSP or a TFSA or any of the other acronym accounts that the government invented. It's just a regular, not invented by the government account. And any interest you earn in these accounts, whether that's from a savings account or a GIC or a bond, whatever, is fully taxable. For instance, if you earn $1,000 of interest in your savings account, that $1,000 is fully taxable. So if your top tax bracket is 29%, then you will have to pay $290 of that $1,000 that you made in tax. If your top tax bracket is 40%, then you will pay $400 of that $1,000 in tax. Yep. Now, let's look at lower tax sources of income. And again, the list is not exhaustive, but it hits the common ones. Capital gains in non-registered accounts and on the sale of additional real estate properties. A capital gain is simply the gain you make when you sell something for more than what you bought it for. So if you bought a stock for $10 and you sell it for $12, then you have a gain of $2. And in Canada, only half of your gain is taxable. Now, as of the time of this video, our current government is actively working to increase the portion of a capital gain that is taxable. But let's just keep this simple and hope that that falls flat on its face and that the next government that comes in throws it out on its ear. The key point to know here, though, is that only a portion of a capital gain is taxable. So that is why capital gains are considered a lower tax source of income. And the same goes for selling a piece of real estate that is not your principal residence, not your main home. If you sell it for more than you bought it, you have a gain and you have to pay tax on that gain. Now here's hoping that it'll remain or go back to being only half taxable. Canadian dividends paid in non-registered accounts or from privately held businesses. Now, dividends are simply a way for a company to share the profits that it has made with the people who own that company. So if you have shares or stock in companies, whether private or publicly traded, and they pay out dividends, you will end up with dividend income, and that is taxable. Now, we are definitely not going to get into the various kinds of dividend income and how they're all taxed because that is its very own, very boring video. But the thing you want to note is that dividend income is typically taxed much friendlier than interest income. All right, last but definitely not least, let's look at no tax sources of income. And again, the list is not exhaustive, but hits the most common ones. Withdrawals from a TFSA. Any money that you pull out of a TFSA at any time is totally tax-free. Awesome. Most monetary gifts, especially when they're coming from family. An inheritance. There is no inheritance tax in Canada. Now, that doesn't mean that the person who passes away won't have taxes that their estate needs to settle. They very well might. But what it does mean is that whatever ends up in your hands after the estate has settled its taxes will not be now taxed in your hands. Guaranteed income supplement. This is a benefit for those who are receiving old age security and have an income below certain fairly low thresholds. This benefit is totally tax-free for those who are able to get it. Sale or downsize of a principal residence. Any money that you make from the sale of your main home, whether you're selling it outright or just downsizing it, any of that cash is totally tax-free to you. Money in the jeans. Okay, now that you know how tax rates work and how different things are taxed, you need to marry this knowledge so that you can build out your withdrawal strategy. For instance, you may find that it's beneficial to take the bulk of your income from your fully taxable RIF account and then just top up the rest with some partially taxable capital gains and dividends from your non-registered account so that you can keep from sliding up into a higher, more aggressive tax rate. And if you find you need even more income but still want to avoid sliding up into that higher tax bracket, maybe it's a good idea to include some TFSA withdrawals as well, since those are totally tax-free. Or maybe you have CPP, OAS, and defined benefit pension income as your base income. But you also have a RIF and a TFSA account and aren't sure how much you should be drawing out of those each year. Well, now you can look at your tax rates and find the blend that works best for you, both now and over the long run. The point is, you can control your top tax rates by knowing where the rates change, how your accounts are taxed, and how much you are pulling from each one of them. Now, obviously, in some cases, some people will not have a lot of options here. Maybe all of your sources of income are fully taxable, and so you'll just have to take what you have to take, and that's totally fair. But in many cases, there are options. There is some flexibility, and so with just a small amount of knowledge, you can save yourself a ton of tax over the long run. Must know number 3, sidestepping major withdrawals during major market downturns. Okay, this last must know has little to do with taxes, but can still save you a ton of money by helping you not lose it. We here at Well-Built Wealth are big fans of having a war chest or cash reserves going into retirement. I've got a whole video on that, and if you haven't seen it, truly, it's worth your time. But since I beat the topic with the stick in that video, I'm not going to do it here. But here's the key points. Having a solid chunk of money set aside in something that never drops in value and is easily accessible at a moment's notice, like a high-interest savings account, not only gives you peace of mind and a place to grab money from when large expenses pop up, but it also gives you the ability to avoid selling your investments during a time of nasty market volatility. Let me draw this out. When markets are going up, it's pretty likely that the value of your investments are going up too. But markets don't always go up. Sometimes they throw fits along the way, and some of those fits can be particularly nasty and can last quite a while. Now, obviously, when markets are going up and you are withdrawing from your investments, you are selling at a profit, and that's lovely. And that causes you zero concern. But when markets are in the toilet, your investments are down in value, and that can cause considerable concern. And that's fair. No one wants to sell anything at a loss. And while there are some fancy pants strategies to try to dance around the issue, the most straightforward way to handle the situation is to turn off the taps on your investment withdrawals and simply take what you need from your cash reserves, since they haven't dropped in value at all. Now, it should be noted that you can't always turn off all of the taps completely. Some accounts, like RIFs and LIFs, have minimum withdrawal requirements, and that's fine. Just turn the taps down as much as possible and take the rest from your war chest. And then, once the markets recover and bounce back up, you can turn the taps back on and simply work at topping your war chest back up so that you're ready to rock the next time the markets face a tornado. Rinse, wash, repeat. Okay, now obviously there's way more to know if you want to fine-tune and become an absolute ninja at retirement withdrawal strategies. You're going to want to consider things like tax credits, income splitting, spousal RRSPs, different phases of retirement income, old age security clawback, which registered accounts to focus on first, etc., etc. It's actually a bit dizzying because each variable affects all the rest of the other variables. And we're spoiled because the software we use takes everything into consideration and it automatically recalculates everything anytime we change anything. We can literally see how much tax you'll pay now and for the rest of your life. It shows us the math right away so that we can make a fully informed decision about what we want to do and how we want to do it. It's pretty awesome. And now that we have it, I wouldn't want to do the work that we do without having it. I don't even know if we really could. Or maybe we could, it would just take forever to do the calculations. Sick. Anyway, the point is, as long as you understand those 3 must-knows, you are well on your way to saving a ton of tax and a ton of grief.